The recent rally in global financial markets, spurred by the tentative ceasefire between the United States and Iran, marks a pivotal turning point for investor sentiment in 2026. After weeks of extreme volatility and a heavy war premium weighing down major indices, the S&P 500's climb to 6,824.66 signals a renewed appetite for risk assets. This upward momentum was further reinforced by the Nasdaq's 0.83% gain, as tech and growth stocks responded positively to the reduction in geopolitical tension. The relief is palpable across trading floors, especially as the threat of a full-scale naval blockade in the Middle East begins to recede. A major driver of this optimism is the potential stabilization of the Strait of Hormuz, a critical choke point for the world's energy supply and maritime trade. During the height of the friction, shipping insurance premiums skyrocketed, and logistics firms faced massive operational delays, causing a ripple effect of inflationary pressure globally. Now, with the ceasefire holding, there is a growing expectation that traditional trade routes will soon return to full capacity. This prospect has breathed new life into the international shipping and logistics sectors, which saw immediate stock price surges as the cost of doing business is expected to drop. Furthermore, the news that Israel is entering peace talks with Lebanon has added a second layer of stability to the region, convincing skeptics that the truce might actually be sustainable. This broader diplomatic cooling has allowed the markets to shift their focus from wartime survival to economic fundamentals. Investors are now looking closely at how this de-escalation will impact crude oil prices and, consequently, the Federal Reserve's path for interest rates. If energy costs continue to soften due to improved regional security, it may provide the necessary room for central banks to pivot away from their current restrictive stances. Despite the positive momentum, institutional traders remain cautious, keeping a close eye on any military movements that could break the fragile peace. The current relief rally is highly sensitive to breaking news, and any setback in the diplomatic process could quickly erase today's gains. However, for the moment, the market's trajectory is defined by a sense of hope. The decoupling of the war premium from asset prices is allowing for a more rational evaluation of corporate earnings and long-term growth prospects. As long as the ceasefire remains intact, the path of least resistance for global equities appears to be upward.